Good day all. Ira Epstein of Linn Associates with your SPDR ETF wrap-up, and this is for Thursday, the 7th of May, 2020, and we're about 5:15 in the afternoon. I've watched the futures reopen, and they were steady to higher in all the stock indices. You know, the day behind me, if you take a look, just a few charts, a few markets were in the red. Most were in the green. You had breakouts in the gold market. You have not taken out on the futures the highs of the April indices, but obviously QQQ has made new highs. And it's a world of tech versus everything else. That's really what it's about. This is a world where, or a time and place, where the COVID-19 has shifted and given millions upon millions, hundreds of millions of people forced into looking at tech, be it the Netflixes, buying from Amazon because they can't go anywhere else, using apps in ways they never did, working out with the Pelotons. I mean, just think of what it's all done and brought a whole group in there. Now, how long they stay? Well, there's going to be quite a few that stay and stay forever now in the new world that we're creating. And that's because we don't throw the switch and go back to normal. The question is the market getting ahead of itself? The elephant in the room tomorrow is the employment data. We are expecting 16% unemployment. Get up to 20, it shakes the market. But even that, I don't know. This is a market that in the techs, they just look at it, it doesn't matter. Other markets might care. So let's go to the charts and see what they're telling us. But I'm going to go first on record. One of the things that I have learned over my many years of trading is don't go through major reports. I had some experiences that I can't even begin to tell you over the years, things that I never thought can happen to clients, to me, all from going honestly through reports. You stay away from them, and yeah, there still can be an event, there could be a war, there can be things, I went through the Nixon era and all that. Yes, there's things that can happen, price freezes and all, but you generally have an inkling something's going to happen. A report, they're telling you right up front, there's going to be numbers tomorrow. How the market reacts to it, who knows? The first thing that happens when the number comes out is the algorithms step in. They can enter an order quicker than you can take a breath. Understand that. And they can get out of that trade by the time you're just inhaling everything. Very fast movement. So you stand back. You let them have their moment. And they do. They're entitled to it. Let them have their moment. Don't fight with them. Now, what we've had here is a heck of a rise. We know it's a technology market. It came back, and frankly, I don't think most of us saw it down here that this was just going to be the run that it's had. It's 8 weeks of running, and it's been nonstop. I agree. Absolutely. Fibonacci counts, out the window. They don't matter on that market. What does matter is the fact that you got higher lows and higher highs. You step out of that every now and then, but in relation to the 18-day average, you have stayed over it. So the bias of the market keeps you bullish. Here's how I define bias. When the market is over the 18-day average of closes, I have a bullish bias. When the market is under it, I have a bearish bias. Until the two change gears, that's how I work with it. Now, the filter of the swing line for me is the 18-day average. As long as the market's over it, when I get a new signal out of the swing line, another buy signal, or under it, another sell signal, because they do come, that's what I'm looking for. Okay. The other thing I pay a lot of attention to are these Bollinger Bands. Yes, you went up to the upper Bollinger Band again. The algorithm is designed so that only 5% of the time you trade over it. Now, that doesn't mean that when you hit it, you're bearish. That is not what it's about. There might be better opportunities to come in, but it also means to me that as pros, as algos, I think they're programmed to take some money off the table. I mean, there's nothing worse in trading than never cashing in part of your position if you're just building it forever wonderful until it all goes against you. And inevitably, there's a shock in the market of all types, and things do that. So you want to be taking money off. You may not even want to put it back in that sector. You may want to do rotations. There's many things that go on, but doesn't mean you're walking away from it. You hit numbers going into a major report where I think the pros have taken some cash and they have reserves to decide what do they want to do. When I look at the momentum, it is up. Now, how many days do we have up in the slow stochastic? Both numbers were over 80 today, both over 80 yesterday and the day before. Now, the day before they were not. So the market is embedded. It means it has changed gears from being overbought to getting bullish. There's two parts to that. If the red line closes under 80, that means the market's going to fall back to the first key moving average, which is the 100-day. So that's something I always look. Price follows momentum. Momentum doesn't follow price most of the time. I cannot prove that every day it works that way, but if you take a look and you study momentum, I don't care if it's relative strength indexes, MACDs, whatever you want. The idea is that momentum is going to lead the price in the market. Right now, that momentum is bullish. SMH, not as bullish as the XLK. You have a lower low, higher high. That is not a trend. Momentum, just sort of in the center, not doing much. Resistance, the 100-day. Now that makes sense because when you got over it, first time you got to it, you were fighting at it. Then you hit the Bollinger Band, ran out of the momentum. I think the pros came out, went back to the 18-day average and the 200-day average, and have popped back to the 100. But I can't say there's a trend here. I can say that there's sideways action in that market. In the industrials, well, this gets interesting. If the market were to take out 60.79, what happens? We would have a pattern then of lower highs, lower lows, putting into play the lower Bollinger Band. What about if that's number right here is 60.79? What's this number? That is 60.60. So the point that I'm trying to make to you is 60.60, 60.79, take out 62.56, you can get the upthrust. You're right in that dead center, and that's what I keep saying. From that 18-day average, many setups happen. You have to have stops on either side. You can get whipped all day long on it, but that's what the market's setting up with resistance at the upper band, support at the lower band. In the energy sector, you've been in an uptrend, but you're overbought. This is not my favorite when you get overbought. You've got higher lows, higher highs, and all of a sudden you're rolling with that. And what are you rolling against? Hitting that upper Bollinger Band. That's the problem for this market right now. QQQ went through, and I've said that, the April highs. But where did it stop today? You don't have to believe me with Bollinger Bands, but you go and look at them yourself. Take a look, and the key is learning how to read them. That's the art I teach. I at least teach my point of view on them in my charting course. When you look at the emerging market, the setup is trying to be bullish again. Higher lows, higher highs, neutral momentum. The market's waiting for tomorrow, and look at this narrow. This is what I call the pipe. Think of this as a bottle that melted on your stove and you get into these pipes. And as you do it, as the volatility comes out, you start bouncing around and you're looking for breakouts one way or the other, and you get thwarted. Because as you hit these upper numbers, the market runs into that fence, that Bollinger Band. You can eventually get out of it. In fact, the narrower the pipe gets, the greater the probability that you're going to break out and create a pattern that came from how thin we were there, and that one created a monster. But it's often coming from that pattern. So you've got it, and the trick is to recognize it. Now, some people try to play it a little different. As it narrows in dramatically, they'll start throwing money at the market, and they'll buy some calls and buy puts further away from the market, trying to catch a move that if it goes into an extreme, they suddenly go into a lot of money. It's another strategy. When you take a look at gold, gold turned bullish today. Higher lows, now higher highs. So I think that the pros are going to buy this market at 160.85. I think that they may have gone home long already. Stop 158.10. I think they'll peel some of their position at 163.74. They'll see what happens at the upper Bollinger Band. Doesn't mean it's getting up there, by the way. In the gold miners, well, we've got the embedded reading again. Until it's lost, you just got it. You know the target that I have in mind. Lose that reading, I'll change my opinion. TLT, what did I say yesterday? First challenge of the Bollinger Band. You may not agree with me. That's where I think the pros are taking money off the table. Now they'll wait and see. I don't think they're going to do anything tomorrow other than see the numbers and then decide what to do. I still believe that's going to be the case. In fact, I think that's going to happen in most financial markets. I think look, that's not the ag markets that I'm talking. I'm not talking the meat markets or the soft commodities, but I am talking the currencies, the interest rates, the stock indices. Yeah, I'll be watching those. Here, no trend. You went to the upper band, you're making a run at the lower band, just missed it today, but you're not trending. You got a higher high, lower low. So I put it all together. I try to give you a game plan. And what many of you don't realize is I write twice daily market reports. They go hand in hand with the videos I put out at the end of the day, be it the spiders or the regular futures videos, the one that I put out in the morning for the morning subscribers to my futures video. But it's all part and parcel. I may even roll them together and give you a package deal. But if you'd like to see what I write about, it's short reading. I don't believe in writing books. I think paragraphs can do the job. Sometime you need 2 or 3 of them. That's it. If you got to write more than that, you haven't made your point or you don't know how to write what your point is. It's not about proving your point. It's making your point. I'll let others write the 5-page theses, 10-page theses on why the market's going to go this way or that way. First of all, we don't know. You're just making a guess as to what it is and trying to back it up with fundamentals or chart action. Go to our website. You can sign up for it there, a free offer if you haven't tried it. You can click up here if you watch me on YouTube. That'll get you there as well. I'm Ira. You have a great day, and I'll see you all tomorrow. Whew, gonna be crazy.